We've got Ramesh Iyer, Managing Director and CEO at M&M Financial Services, joining us on the show. Ramesh, to begin with, if you could give us some details on how your business has been panning out so far in terms of demand in each of the segments that you're operating in, loans for auto, utility vehicles, tractors, cars, etc.
I think we've had a good quarter, I must say, amidst whatever that we've been hearing otherwise. The semi-urban rural market continues to be doing okay, that's one. But I think more importantly, since we've got into multiple product segment even within the main segment, like for example, within the car segment, we were largely Maruti Car Financial earlier, but we've got into multi-product range. I think that's helped us also grow better. And our second-hand vehicle financing is being doing pretty well. Commercial vehicle construction equipment segment is doing well. So I would kind of summarily put that the first quarter continues to be as exciting or as buoyant as we saw in the previous year. So we've not had any pressures on the asset side.
Right, Mr. Iyer, given that, your presence is largely rural and semi-rural areas, give us a sense of how you expect business to pan out given the slowdown that we've seen in the overall economy plus the delay in the monsoon.
Let's put it in three formats. One is, of course, when you talk of slowdown in the overall economy, it's largely some infrastructure projects not doing well in some parts of the country, but it's not true across the country. So, if you look at state-by-state strategy, I think Rajasthan, Gujarat, MP, part of Maharashtra, in some pockets have done well, South is not done so well. So there's one sense of some slowing down around there. And I would kind of put it across saying earlier, a lot of buying was happening. Now possibly selling will have to happen. I know we are seeing discounts being offered or some subventions being given to finance companies to be able to match rates, etc., etc. And as far as the monsoon is concerned, possibly a little too early to comment on whether it's good or otherwise. But definitely as the rural customer does look for this sentiment, and if the monsoon turns out to be average plus, then we would think the second half should do pretty well.
Right. So Ramesh, just to put this a little differently, how dependent are rural sales for Mahindra and Mahindra Finance and how dependent is it on a good crop?
See, actually the sentiments definitely, people look for to be a good monsoon. But if you look at the cash flow, it's no more just farm dependent. Even when we do about 18% of our balance sheet comes from the tractor application, but within that only 12% has got direct farm implications. As otherwise the multiple cash flow streams which come from contracting segment, trading, people carrying, all this multiple segment seems to be doing pretty well. And, the proxy for whether the rural does well or otherwise, one should look at two proxy. One, what is the overall collection efficiency? Is there a trend towards an increasing NPA, etc.? I think in the first quarter we've seen the collection efficiency have been pretty good. There's been absolutely no signals of NPA going up. The second is, what's the loan to asset value? Are people asking for 80%, 90% loan? Then there is a signal to pressure on the margin money or for that matter the cash flows. We've seen the LTVs actually have come down to 65, 67% level. So the genuine buyer seems to be able to bring in 30, 35% cash. I think the third proxy is what percentage of total sales is cash sales. And if you look at tractor sales, if you look at two-wheeler sales, I think a substantial portion, upward of 20-25% of sales continuing to be cash sales. So I would think if you take these three proxies for what's the economy happening out there, I would strongly think that the buoyancy continues. Yes, when I say buoyancy continues, in comparison, yes, previous year would have been much more aggressive than what we've seen now, but it's not still negative. It's still kind of buoyant out there.
And given the way the interest rate environment is shaping up, how do you see your margins stabilizing?
See, again, the market that we service, we've been able to pass on the borrowing cost. Good news is for last couple of months or plus, there's been no increase in interest rates. And then as you asked a question, I've said this to somebody in the past, all of us are looking at the sky for both whether the interest rates is falling before the rain falls. One of the two has to fall faster.
And you did mention, Ramesh, that asset quality so far has been good. You've also found that your collection progress has been holding up well. But the outlook going forward, do you worry that asset quality could somewhere possibly come under pressure?
See, again, asset quality is an ultimate reflection of what's your loan to asset value. If you give 90% loan, even little slowdown to the economy will impact the asset quality. There's no question whatsoever. Therefore, when the LTVs are much lower at about 65-70% level, even if there was little slowing down to economy happens, the EMI is well accommodated within the available cash flow. We are not able to see cash flows getting any stress. We are comfortable to believe that, normally another 3 months left, July, August, September, which is the monsoon period where the economy slows down. The second half substantially picks up, if the festival, the wedding season, then the harvest. So if these 3 months we are able to hold on to what we are saying, we would actually see a much better year panning out, because the second half normally is a much better half in the rural India.
And also, Ramesh, just one quick word on securitization. You're reasonably active in the securitization market, but the draft guidelines on securitization, if they do indeed get finalized, what's the impact you see on your operations?
See, about 10 to 12% of our portfolio we used to assign, and if these guidelines do come out to be the way they are, and therefore the borrowing cost getting a little impacted, I think 20 basis point impact on the borrowing cost is very clearly visible if they are the way they are. But the good news along with that is, somebody just 10% of the portfolio being assigned would mean there is a quick alternative to be able to raise liquidity to match the requirement. And the third is, you need to now hold the asset for at least 6 months in your book before you can securitize, which means somebody who's got adequate capital already in the system will be able to honor that requirement. So an asset like a tractor, which does not require any explanation on whether they are a priority sector, possibly would be in demand, while the overall supply on the securitized market will come down, and therefore a specific asset like this could have a higher demand. But the rate impact of 20 basis points can't be avoided.